Hello, everyone. We are going to kick off our discussion of tax planning strategies by talking about the first strategy, which is timing. So, whenever we think of timing strategies, the key word that we need to think about is when something is going to happen. So, when is this income going to be taxed? When is this expense going to be deducted? So I'll highlight the word when in here. There we go. When. When will something happen? And the reason why timing is important is because as individual taxpayers, we follow a cash basis. And so when we put that in perspective, timing is critical for us because the present value of the taxes that are paid on income or the tax savings we get from deductions is impacted by time. Additionally, the taxes paid on income and tax savings we get from deductions can vary as tax rates change. So the rate could be 20% in 1 year and then 25% the next year. That change in rates could influence when we might want to do something, and we'll talk about that in a later video. For this video, we're going to stick more with the assumption that if tax rates are going to be constant year over year, what would we want to do? And so a big formula that will play into the timing strategies is the present value formula. So present value equals the future value divided by 1 plus your rate of return to the power of your years. So n is supposed, that little superscript n, that is supposed to signal the number of years. And so on an exam, you can certainly use this value, but in your big packet full of tables, schedules, and rates, there will be a present value table available that can shorten this calculation process up a little bit. Additionally, some things to keep in mind as we're going through and thinking about our present values. Whenever we have a cash inflow, we will want a higher present value. And that is because that means that if that value is higher, that means there is more money coming in for us. For cash outflows, so if we are paying something, we want lower present values for those. And why would we want that? We would want that because that means that we are paying less money or a lower amount for something. So whenever we go through the timing strategies example problems in the next couple of slides, I want you to notice that the two big things that we're going to be looking at are examples of accelerating deductions and deferring income. And the reason why those are the questions we're contemplating is because both of those actions, accelerating deductions and deferring income, can help reduce taxable income. So when we think about accelerating deductions, we're trying to make our deductions larger. So if we have $100 in income, we'll keep it really small numbers, $100 in income. If we had $50 of deductions versus $60 of deductions, we would want to have $60 in deductions, so that way we're only paying tax on $40 instead of $50. From the deferring income side, what we'll see is we will want to make the income amount, let me add another word in here, hold on. Okay, make our income smaller. So if we do some quick math with some small numbers off to the side, say we have $90 in income and $100 of income. And let's say we have $50 in deductions for both examples. So then we have $40 and $50 of taxable income. We would want to have, in this case, the lower income number, because then we'll only have to pay tax on $40 instead of $50. So let's look at our first timing strategies example. So this one is going to be from the perspective of a deduction. And whenever we read the problem, we're going to assume that the tax rates are staying constant year over year. So let's take a look at our fact pattern. Mercedes, a calendar year taxpayer, uses the cash basis method of accounting for her small business. On December 28th, she receives a $10,000 bill from her accountant for consulting services related to her small business. She can avoid late payment charges by paying the $10,000 bill before January 10th of the next year. Assume that Mercedes' marginal tax rate is 30% this year and next year, and that she can earn an after-tax rate of return of 10% on her investments. When should she pay the $10,000 bill? This year or next year? So let's take the information from our fact pattern and get ourselves organized. So some key words, if you were ever to see a problem like this on an exam, key words that I would look for to help signal if it was deduction or an income question. Let me get my highlighter so we can highlight some of those key words. So on December 28th, she receives a $10,000 bill. She can avoid late payment charges And then when should she pay? So if we're paying something, that would be an expense to us, which would ultimately allow us to potentially take a deduction. So now let's get the information from our fact pattern organized. So the main question we are trying to ask, or answer, I guess. Are we paying this bill this year or next year? So let's take a look at our calculation for this year. Whoops, lost my pen. There we go. Okay, so this year. We take our $10,000 bill, and then we find our tax rate. So it's 30% this year and next year. So for this year, the tax savings related to this $10,000 bill is $3,000. So 3,000 tax savings. Our after-tax cost of this $10,000 bill. So after tax cost equals $10,000. So that was the amount of the bill originally, minus our $3,000 in tax savings. And that gets us $7,000 in our after-tax cost. If we look at next year, so next year, if we think about the concept of the time value of money, and that's why we have those present value tables. Time value of money means that $1 today is not going to be worth the same amount as $1 tomorrow, a year from now, 5 years from now, 10 years from now. And so whenever we make the comparison between this year and next year, we try to convert everything to the present value so that way we're comparing apples to apples. So the way we would look at next year to see what the tax savings and after-tax cost would be, we would have our $10,000, so same $10,000 bill, multiply it by 30% because that's our marginal tax rate. But we also need to add the addition of multiplying by the present value factor. So if we look on the present value factor tables, the number that we will want, if you look in the very first column when it says year, we'll look for year number 1, because we're assuming, oh, this year and next year, it's only a 1-year difference. And then the problem tells us that the after-tax rate of return on investments is 10%. So then whenever we're looking across the columns for the different percentages, we will want to find the value that is at the intersection of year 1 and 10%. So in this case, I'm sorry about that, guys. I was on my eraser magically. That present value factor will be 0.909. And so then if we do all of that math, we will get $2,727 in tax savings. So then subsequently, we can see that our after-tax cost equals $10,000 minus 2,000. What? Let me erase. Sorry about that, guys. 2,000. Oh my gosh. I'm sorry. I cannot write today, guys. $2,727. Which should give us an after-tax cost of $7,273. So let's highlight our answers here. So now that we've done the math, the question we want to answer is, should we pay this bill this year or next year? If we look and see, we would want to pick this one. Here, I'll actually highlight it. We would want to pay the bill this year. Oops, I meant for that to be green. Let me try that again. We would want to pay it this year because we can look at it a couple different ways. We would want to pay it this year because we'll have greater tax savings. So $3,000 versus $2,727. Or another way to think about it is, if we pay it this year, we'll have the lower after-tax cost. So $7,000 is less than $7,273. So we would want to pay the bill this year. Now let's take a look at an example of a timing strategy problem from the income perspective. And as we go through the fact pattern, we're going to see that we are going to continue to assume that the tax rates are constant. So, Manny, a calendar year taxpayer, uses the cash method of accounting for his sole proprietorship. In late December, he performed $20,000 of legal services for a client. Manny typically requires his clients to pay his bills immediately upon receipt. Assume Manny's marginal tax rate is 37% this year and next year, and that he can earn an after-tax rate of return of 12% on his investments. Should Manny send his client the bill in December or January? So if we take a look at our fact pattern, and let's imagine we were in an exam situation. Some words that stand out to me in the fact problem that would signal that this is an income problem, or we would want to look from the income perspective. Manny requires his clients to pay the bills immediately. And then should Manny be sending his client something? So if we are sending something for someone else to pay, whenever that someone else, in this case the client, pays the bill, that becomes income to us. And so ultimately, the question that we want to answer at the end of all of our calculations: should Manny send this bill in December or January? So let's work this out. We'll organize the information from our fact pattern. So let's start with the calculation for this year, because that one will be the easier one to get through first. So if Manny sends the bill this year, so this year, the bill Manny is trying to send is $10,000. $20,000. I think I was thinking $10,000 from the previous problem. Sorry, guys. The bill is $20,000. And the fact pattern mentions that his tax rate is 37% this year and next year. So if we multiply that by 37%, that will get us $7,400 in tax. Then subsequently, the after-tax income equals $20,000, because that was the original bill that Manny would send, minus the $7,400 in tax, and that will get us $12,600 in after-tax income. Let's take a look at next year, so January. So next year. So we still have that same $20,000 that Manny is trying to receive. Marginal tax rate is still 37% next year. However, since we know that $1 today is not worth the same amount as $1 in the future, we will have to convert this amount into today's dollars, or the present value dollars, so that way we can make an apples to apples comparison. So the way we can do that, an important fact to note from the fact pattern, is that it mentions that Manny's after-tax rate of return is 12%, so that'll help us read the present value table. So if we go to our present value table, we will want to find the value that intersects for the row for year 1 and the column for 12%. And so that present value factor should be 0.893. So then if we multiply all of those things together, that will get us $6,608 and technically 20 cents, but to keep the math simple, I'll round it to the nearest whole dollar. So $6,608 in tax. So then subsequently, the after-tax income will be the original $20,000 pre-tax minus the $6,608 in tax. And that will get us after-tax income of $13,392. So now that we've done that math for the comparison, let's go back to our original question. Should Manny send this client the bill in December or January? Whenever I look at this, I would want to send the bill next year, so probably the beginning of January. And the reason why, we can look at it a couple different ways. If we compare this year to next year, the tax amount next year is lower. So, of course, we would want to pay less in taxes if we're able to. Another way to look at it is, next year, our after-tax income is a little bit higher than what it would be if we send the bill this year. And of course, we always want to have higher after-tax net income. So for this question, we would, let me make sure I'm on my pen, send the bill in January. Alrighty, that is the end of this video. Stay tuned because the next video we are still going to be talking about timing strategies, but we're going to get into, I guess, a little more advanced math, because now we will be considering what we might want to do if tax rates are changing year over year. So if they're increasing or decreasing. I will see you guys soon.